Welcome back to our YouTube channel, The Book Digest. In today's episode, we're diving into a powerful and practical summary of Common Stocks and Uncommon Profits by Philip A. Fisher. Now, this book was first published way back in 1958, but trust me, it's not just some dusty old text. This is one of the books that literally changed the game for how generations of investors, including some of the biggest names out there, think about building real, lasting wealth. And hey, you don't have to take my word for it. The one and only Warren Buffett said Fisher was one of the two biggest influences on his entire investment philosophy. I mean, that's about as big an endorsement as you can possibly get, and it really shows you why these ideas are just as powerful today as they were decades ago. So here's the game plan for how we're going to break this all down. We'll kick things off with Fisher's core philosophy. Then we'll get into his famous scuttlebutt research method. After that, we'll look at his 15-point framework for finding truly great companies, cover his super strict rules on when to buy and sell, and finally, we'll talk about why his legacy is so important. All right, let's get into it. First up, the Fisher philosophy. This is where Fisher really broke the mold. See, back then, most people were just looking at stock tickers and charts. Fisher said, forget that. He wasn't interested in the noise of the market. He wanted to understand great businesses from the inside out. Now, to really get a handle on what Fisher was doing, it really helps to compare him to another giant of investing, Benjamin Graham, the father of value investing. Graham was a numbers guy, a master of digging through financial reports to find stocks that were just plain cheap. But Fisher, he took a totally different approach. He was all about the qualitative stuff, the things you can't find on a spreadsheet. He asked, what's the long-term potential here? Is the management team any good? And what's the company's real competitive advantage? And that brings us to Fisher's main idea. And you know what? It's shockingly simple. He argued that the way to make truly incredible money isn't by trading all the time or trying to guess what the market's going to do next. No way. It's about finding just a handful of absolutely outstanding companies, buying them, and then just holding on for years, maybe even decades. You let the power of compounding do the heavy lifting for you. Okay, so that sounds great, but how in the world do you find those amazing companies? Well, that brings us to Fisher's most famous idea of all, the scuttlebutt method. And this is where the real fun begins. It's less about accounting and more about becoming a detective. Fisher actually coined this term, scuttlebutt, for his process. His whole argument was that financial statements are like looking in a rearview mirror. They tell you where a company has been, not where it's going. He said to understand the future, you have to get out there and actually talk to people who are connected to the business, which of course leads to the obvious question, okay, who exactly are you supposed to be talking to get these kinds of insights? And this is what really set Fisher apart from everyone else on Wall Street. He said you should talk to a company's competitors to find its weak spots, talk to its customers to see how loyal they really are, talk to its suppliers to get a sense of its health. Now look, you and I probably aren't going to get the CEO of a major company on the phone, but we can use the same idea today. Think about it. You can read employee reviews on Glassdoor. You can dive into forums and see what real customers are saying. The point is to dig for those things you can't quantify, like the company culture or how good their research team is, because that's what really drives success in the long run. So once you've done all that detective work, you need a way to organize all your findings, right? And that's where Fisher's legendary 15-point checklist comes into play. And I want to be clear, this is not a simple check-the-box kind of thing. It's a whole framework for thinking through every single critical piece of a business. Yeah, 15 points. And these questions are designed to build a complete 360-degree picture of a company. They force you to look at everything, from its sales organization and labor relations to its market potential and, most importantly, the integrity of its management. For Fisher, a company had to look good across the whole board to even be considered. Now, we can't go through all 15 right now, but they really boil down to these three huge categories. First, you've got market potential. Basically, does this company have a long runway to grow? Second is the financial outlook. Is the company focused on building value for the long haul or just trying to make next quarter's numbers look good? But for Fisher, the ultimate deal breaker, the absolute non-negotiable, was management. He demanded unquestionable integrity. Why? Because he knew that a fantastic business run by shady people would sooner or later find a way to burn its shareholders. Okay, so finding a great company is half the battle, but knowing when to pull the trigger and, just as importantly, when to sell, that's a whole other ballgame. And this brings us to Fisher's practical rules of the road. Fisher had this great list of don'ts, basically common traps that investors fall into all the time. He warned against buying into promotional companies that are all hype and no substance. He said, don't get hung up on a stock's recent high price. That number is totally irrelevant to what the business is actually worth. And he argued that getting obsessed with a simple metric like the PE ratio is a huge mistake, because it just doesn't tell you the full story of a great growth company. Now, when it came to selling, Fisher was incredibly disciplined. He said there are only three, and I mean only three, legitimate reasons to ever sell a stock. 1, you admit you made a mistake in your original analysis. 2, the company itself has fundamentally gone downhill. Or 3, you find another opportunity that is just clearly massively better. But notice what's not on that list: selling just because the stock price went up. For Fisher, that was the biggest mistake of all, because that's how you cut yourself off from those life-changing long-term gains. And this all brings us to our final section. Let's pull back and think about why these ideas from the 1950s are maybe more relevant today than ever before. Fisher's legacy isn't really about a bunch of stock tips. It's about a timeless way of thinking. This quote right here, it just perfectly captures everything Philip Fisher was about. The goal isn't to be clever and outsmart the market's day-to-day craziness. The goal is to become truly wise about what makes a business excellent and built to last. It's a fundamental shift in perspective from just looking at prices to really thinking like an owner. And that leaves us with one final thought. In our world today, which is so dominated by algorithms, high-speed trading, and a constant obsession with what's happening right now, doesn't Fisher's patient, investigative, business-first approach seem more valuable than ever? It's definitely something worth thinking about.